In this video, guys, we're going to look at the analogy between insurance and option pricing. Hey traders, a very warm welcome to you. So let's have a look at option pricing with an insurance analogy. So some of the key things that affect the price of an option is the time to expiry and the volatility, expected volatility of that option. Obviously, we've got the strike price, we've got the interest rate, all that other stuff, but these are the big things. And let's look at an insurance analogy to see how the price of option may vary. So you are going to have to forgive my little drawings here. Fortunately, I'm a better trader than I'm a drawer. Okay, so we've got a guy here. This guy here has just purchased his car. He's got a nice car, he's bought it, and he wants to insure the vehicle, right? So he would go to an insurance broker, insurance agent, whatever it may be, and he says, listen, I want to insure the car. And the guy says, okay, how long for? And he says, a year. He says, great, that's going to be $1,000. Nice car, and lots of risk on this. Okay, he pays his money, gets his contract. Now, if he wanted to insure that car for 2 years, it's not going to be $1,000 because the risk of him having an accident is much wider, right? It's much bigger because he's got 2 years for that accident to occur. So the guy's probably going to say 2,000. Maybe gives him a little bit of a discount, but you get the point. If he says I want to insure it for a week, it might only be $100. You get the idea. The longer the risk is, or the more duration the risk, the more the insurance is going to be. So that's why in options, when you're looking at a very long time to expiry, the price goes up and up and up because, of course, the longer duration, anything can happen in the market between now and then, as opposed to, say, a weekly, which has only got a week's worth of market conditions. So you can see with the insurance analogy here as to why it would be more expensive. And that's ultimately what a buyer is doing anyway when they're buying an option. If you forget about a speculation perspective, if you're buying an option, you're buying insurance. You're buying the right to purchase or sell that stock, depending on which way you're positioned, at a specific point in time, at a specific price. Just like you're buying insurance on your car here that says, hey, you have the right, which you obviously would take, to get the purchase price of that vehicle or the valuation of that vehicle in the event the vehicle gets stolen, burnt, or has an accident. You get the idea. So, but the seller of the option is basically assuming the risk for the premium. Just like if you are buying your car insurance, you're basically saying, hey, I'm prepared to pay for someone to take this risk for me. You know, okay, in countries you have to do it by law because of various reasons. You know, you might have the money to cover some sort of serious accidents, but the idea is that you're paying somebody to assume that risk, and insurance brokers will assume the risk on a basket of different items or different risks, should I say, across different vehicles, different age demographics, and that's their business model, right? They assume that they have to pay out on some and not on the others. So just a similar thing like an option seller or writer, he says, you know what? I will assume that risk. I'm going to be paid to assume that risk, and the hope that that risk never happens, i.e. that stock doesn't go to that level, because that's where he would have to pay out. So hopefully it expires worthless and he can just collect the premium and put it in his pocket. Just like your insurance, when you pay your car insurance, you run for a whole year without any problems whatsoever. The guy, the insurance broker, goes, thanks very much for that premium, puts it in his pocket and hopes that will happen again and again and again. But you can see how the time to expiry with that is going to adjust, and the cost is going to adjust of the option depending on how long it's going to run for. Right, let's look at this analogy here. This is your life insurance broker, life insurance company, and they are saying, hey, we're comparing two guys here. Again, you're going to, you know, these illustrations aren't the best. I get it. You've got one guy here, great shape, he works out regularly, doesn't smoke, eats the right food, doesn't kind of parachute off buildings. Yeah, chances of him dying are pretty normal. Perhaps they're less than normal because he's good health. He's, you know, he's keeping on top of his weight, etc., etc. He's got no illnesses, no life illnesses. And then you've got number two. This guy here, overweight, smokes. Perhaps he works in a really dangerous job. You can see the point, right? This guy has got far more risk of dying earlier than this guy. So the life insurance company is going to charge a lot more to cover the risk, to take on the risk, i.e. paying out in the event of a death, of this guy than this guy. So what's the analogy in the options market? the analogy is this. Imagine this one is a really volatile stock. Okay, really volatile. It's like something that's a tech stock, perhaps it's got no earnings, it's very sensitive to news, it's swinging around over the year, massive amount. And this guy is a real kind of steady, plodding stock. It's been around for hundreds of years. It's got a really solid business model. The earnings never shift that much. It kind of chugs along, takes a dividend. You get the idea. The risk on this stock, or this guy here, is going to be way higher. So even if you have a standardized time to expiry, a standardized percentage, you are going to have to pay an awful lot more to cover the risk on the volatile stock than you are the stock that's very steady and is not showing any volatility. So for him to assume that risk, he's going to have to charge more. Just like in this life insurance example, to assume the risk of this riskier guy, you're going to have to pay more premium. Same if you have a volatile stock or a volatile asset, you're going to have to pay a bigger premium to assume that risk, as opposed to something that's chugging along, not doing much, then the premium's not going to be that big. However, the opportunity comes in when, let's say, for example, this guy slims off, loses loads of weight, works in a safe job, now stops smoking, the risk becomes lower. All of a sudden, you can see how the price of that risk would change. And you can think of that in terms of a stock as well. If the volatility of a stock, very steady, suddenly starts to pick up, the price of that option suddenly starts to pick up. If you're holding that option and the price of it starts to pick up, all of a sudden you've made some money. But we'll talk about that in more videos of how we can perhaps position ourselves in specific options just to take advantage of that change in volatility, that change in risk, without waiting to expiry to crystallize those profits.